Hi everyone, welcome to episode 6 of the Boon by Sid podcast. Today we have a very special guest in the industry of profit. Not something you've heard of, I imagine. We have Simran. Hi Simran, how are you?
Very good. How are you?
I'm doing very good, I can't complain. So please tell me a little bit more about yourself.
So I'm Simran Samdani. I'm a co-founder with Excel Accounting. I run this business along with my husband. I'm a pharmacist by qualification, an MBA in marketing, have a consulting background before I came to Dubai, and an
Okay.
ex-banker,
Wow,
and been a partner with Excel Accounting with my husband for the last 18 years.
18 years in the industry.
Yeah.
Wow, I imagine you've seen some big ups and downs of people's
Absolutely.
businesses when they go up and when they go down. So in this podcast, I really want to go through mistakes and insights which entrepreneurs, anybody in Dubai, could use to basically increase their profit, which is what I imagine you do. Just to start off with, what's the biggest mistake you see all entrepreneurs make when they start in terms of finances?
So I think when people start businesses, I think everybody's chasing revenue.
Okay.
And more than just revenue, I think what I would advise people to do is get to know their why.
Mm-hmm.
If you ask anybody, why are you doing your business? They'll say, money.
Mm-hmm.
Okay. Normally, people would leave jobs to start entrepreneurship. I would believe for three F's. One is finance, which is money. One is freedom to do what they want to do when they want to do, and also flexibility. Okay, and they believe that they'll get a lot of time for themselves. But what they don't realize is you need to put all of that first, more than you anticipate. You need to put more money, more time into your business. So what people are doing is probably chasing revenue
Okay.
and not realizing why they need their money for. So I would advise them to step back and ask, why do I need it? And if you ask that why 5 times, why did you start your business? To make money. Why do you want to make money? For different people, it'll be different reasons. It could be sending your child to a very good education that you probably aspired to go,
Right.
or get them the best. It could be to give your parents a house or something that they sacrificed when they were bringing you up and making sure you fulfilled your dreams. It could be traveling all over the world. It could be charity. It could be all of them. But that amount would be different for different people.
Right.
And you don't have that aspiration, or you don't have that figure, then you're just driving around.
Right.
And if you ask 5 whys, why did you start your business? Why did you need that money for? And if you go down 5 times, you'll realize it had nothing to do with money.
Wow.
And that's important. And when I say people chase revenue, it's not revenue. Revenue is a vanity metric. It's what money you keep for yourself at the end of it. We started our business to keep more of the money for ourselves.
Right.
And that's important. The goal should be, what do I need to keep for myself, and reverse engineer the revenue goal.
Okay.
Make profit important. Profit, when I say profit, not what is in your profit and loss statement, but profit is the money that you would want month on month, and for now and for the future, and let your revenues be a function of that.
Wow. That's amazing. And that's something I imagine most entrepreneurs don't realize until it's too late.
Yeah.
And just to summarize it, to make it easy to understand, what's the difference between chasing revenue and chasing profit? I imagine you already mentioned, but just to make it simple.
See, because what you would do is, when people look at their business, and when they are, so say this is 2025, it's now 31st December or 31st October 2025, and you're looking for deciding your revenue goals for the next year. You'll say, okay, I want to grow 1x of my business, I want to 2x my business, I want to do 20% more than what I did this month. This is what the competition did, I wanted to do that. So you're basing your revenue figures on things. A question I would ask people at this time is saying, what if you could double your profits earning the same revenue?
Wow.
Is that more important?
Yeah, 100%.
And revenue not necessarily and would ensure that you're keeping more of the money that you make. If you 10x your business, you 5x your business, you 2x your business, if you've not had your profit goal, these would just be numbers.
Right.
Would you rather be a 10 million dirham company making a 3 million dirham loss, or you okay being a 1 million dirham company making 300,000 profit?
100%. I mean,
Right? At the end,
it's crazy. I know businesses that make hundreds of millions, and the owners keep home what, less than 500,000.
Correct.
It's crazy what's
Correct.
happening right now.
Correct. And not necessarily while you're increasing your revenue, you might be hiring more people, investing in technology, investing in marketing. And I'm saying investing, okay, but at the end of the day, you've not actually tracked what you're keeping back.
Right.
So you're chasing revenue, but at the end of it, frustrated after some time because guess what? You have nothing left.
100%.
You're still struggling to pay payroll. You're still struggling, for certain things, and that's keeping you up at night. It's giving you sleepless nights. And was that chasing revenue really worth it in that case? In case you have planned it with profit, then yes, I'm not telling people not to scale, but it is to be scale smarter.
100%.
Yeah.
And if I'm not wrong, in a business, when you're scaling, which is a topic I really do want to talk on, there's something called a lifestyle business and a business for profit, to keep home,
Yes.
to be ambitious.
Yes.
Is there a phase between your lifestyle and ambitious? Maybe it's between going from 15 members to 30 members in your team, where you will 100% spend more than you make, but in the long term, you will be making more than you spend.
You've seen one of my other podcasts.
I probably
think.
have, yeah.
Okay, so this is very important, and this is something I truly believe in. And it is not my philosophy. It is by a guy called Daniel Priestley.
Okay.
And there's a book called 24 Assets, and he talks about the company growing. So there is different phases of the company, and like my first thing I said, your why. Why do you want to do what you want to do? That defines how big or small you want your business to be. Okay, and there's nothing right or wrong about it. So there is something called a freedom lifestyle business, and there is something called a performance business, but there are other stages to it, which could be building a unicorn. Okay, I'm not even talking about those stages right now. It is for you to know what size of the business that you want to build and what is your purpose for building that business. So if you are building a freedom lifestyle business, that they say that the metric that you need to evaluate is revenue per employee.
Okay.
So if you're going beyond 15 people, it generally gives you an indication that when you're growing, then you're investing more than you're making.
Okay.
And if you want to be a performance-based business, it starts with 30 employees and more. So in between 15 to 30 is what he calls the desert.
Okay.
Okay? A freedom lifestyle business is something that you're building where you're making sure that this is what I want. It's a small business. It's a scalable business. It's giving me the money that I want. It's giving me the lifestyle that I want. And I'm happy with it. I'm happy with it. Okay? And 30 onwards, it requires a different mechanics. And between 15 to 30 is where you are going to grow, but you're going to invest more than the returns that you're making.
Right.
Whether it's going into a bigger office, technology, marketing, etc. Being aware of that is very important. If you know that's what you're building, then you need to understand that you need to scale faster.
Okay.
You have that planned. You have saved some money, and Profit First actually tells you how to do it. You've put some money aside for your growth, and you've planned that growth so that you're not staying or getting stuck in the desert without moving forward. And because at the end, it's all about cash flow.
Right.
Yeah. And if you're, did you know that 82% of businesses fail in their first 5 years?
Wow.
But did you also know that 69% of those businesses were profitable?
Wow.
Profitable on paper. But they had to shut down and couldn't grow because they didn't have the cash flow.
So it's all about cash flow.
It's all about cash flow. So you're making sure that when you're crossing the desert, you have that sustainability to be able to go through on the other side and then thrive.
Can you go deeper into how even a profitable business can fall with that cash flow?
So profitable on paper. Okay, if you have the cash flow and you're managing the cash flow, that's great. It's what you measure gets managed.
Right.
Okay. If I ask people what's your relationship with money, okay, there are 3 stages. In a serious relationship, I know where I am and I know where I want to go and I know how to get there. It's complicated. Basically, I know where I want to go, but I have no roadmap to go there. And the third thing is, don't even look at it. A lot of entrepreneurs make the mistake of not looking at their numbers, okay, because they're scared. There's fear. And in that fear, they feel that some magic will happen and all of a sudden something will get okay.
Right.
Okay. But if you don't see that, you'll not move ahead You
Right.
need to know. Wherever you are today, I tell people, it's fine.
Mm-hmm.
The way from here is up. So if you are a business that's profitable on paper, okay, not necessarily you have the cash flow. Are you measuring how much receivables are there in the market? How many days people haven't paid you?
Right.
When people are getting revenue, you're not chasing all of that.
Mm-hmm.
Okay? But there are times when a scenario like COVID hits and money dries up and everybody says, I don't have money to give you.
Right.
So you have to make sure that you're measuring. Everything about money is it needs to be returned. So if you're investing in something, there has to be a return on your
100%.
money. So that's very important. So making sure that you have a collection process, making sure that every money that's going out, it's called a cash conversion cycle, making sure that you are tracking where your money is going and where your money is coming from.
Uh-huh.
So being aware, I would say to have a cash flow forecast.
Okay.
Do you know what your runway is? Do you know in the next 6 weeks, 13 weeks, what's going to happen? So we recommend people to have at least a 6-week cash flow forecast.
Okay.
So that they're aware of what money is going to be coming into the business, where the money is going to go out, and then it's like a leaky bucket.
Mm-hmm.
Water is coming from top, and if there are holes, it's going. It's trying and plugging those holes so that you can retain more of what you have.
Wow, that's really interesting.
Yeah.
Because a lot of businesses will have lots of leaky holes,
Correct.
especially if they don't track
Correct.
their finances.
Correct.
Wow. And when a business is scaling up or attempting to, when is too early? You know, they think, oh, I have my first or my second or my sixth profitable month. Is now the right time to scale? Or, you know, when is the right time for a business to scale?
There is no right or wrong time. It depends upon your purpose. Okay. First, there has to be a stability. Okay. There has to be certain stability. 3 months, 6 months, 9 months is fine. It depends also whether your business is bootstrapped or you have funds and there are certain goals. So having that decision made is very important. So personally, I believe stability is at least 18 months.
18 months.
18
Okay,
months,
wow.
in my opinion, you should have stable because you have tested the market. It's not a one-off that your product is doing well. You fine-tune your product, you fine-tune your market. You know that this is working, and then you know it's scaling. It is scalable or not, because otherwise you may have to tweak your product or
Right.
service offering and move ahead. There's nothing wrong in scaling earlier or later, but as long as you have a financial backing, you have confidence, you have that vision, but do it very, very methodically.
Okay, wow.
Yeah.
And have you seen in your experience businesses fail because they scale too early?
Yes.
Yeah.
Yes, because a lot of businesses don't know what it would cost them to scale.
I see.
They've not done future projections. They don't know what it would cost them to scale.
They just go in blind.
If I ask an entrepreneur today, if you had a demand for your product 5 times what you have today, are you able to service that?
And that's what scaling is part of.
Yeah. If I'm not ready, if I get business and I get bombarded with 5x, am I ready to scale it? Do I have the right people? I don't want to go into the market and then my reputation that I've built goes away.
Goes away.
It doesn't matter. You have to be ready for that scale up. So if you have to plan that I want to scale and have all your resources, infrastructure ready.
Wow, that's interesting.
Yeah.
And in terms of businesses going bust, you know, what's one very important metric which you don't always see on the spreadsheets that is a cause for businesses going bust?
I think it's founder stress.
Founder stress.
Yeah,
Okay, wow.
It's emotional because at the end, if nothing like this happens overnight, okay, you've seen signs that it's happening, and whether you wanted to accept it or acknowledge it, your gut or for the entrepreneur, there is stress that is coming up, not being able to pay salaries on time, not being able to pay vendors on time. It could be, not getting enough clients. It could be whatever. Before it comes to that, there is that stress. And when you're taking decisions from that position of fog, of stress, of depression, you're not taking the right decisions.
Wow.
Okay, it's so clouded that you're not seeing opportunities. You're probably not taking enough risks. And I feel that is one thing. It may not be a financial metric, but it is something that affects financial metrics.
Wow, that's very, very, that's, you don't think of that, but it's probably the
Yeah.
reason you've seen so many
Yeah.
founders fail.
Yeah.
That's interesting.
Yeah.
And when you see a business rise and when you see a business fall, and in terms of businesses failing and, spending more than they make, what's the first metric you would personally check when a business is overspending?
It's not just about one metric. I definitely, when we go into a business, we do a health checkup.
Okay.
It is not going to be the same metric for all. But if it has to be one metric, it'll definitely be cash flow.
Cash flow.
Okay, 100%. It is something that's affecting the cash flow. Now, what's affecting the cash flow could be various other reasons. So we would get into a business. We would not make any corrections till we do a financial health checkup. By health checkup, I mean we'll understand what their processes are,
Okay.
what's going well. For all businesses, it's not that everything is not going well. There are certain things that are going well. There are certain things that can be improved, and there are certain things that need to be shifted.
Okay.
And a lot of it depends also, I would say, in terms of your processes
Okay.
and systems. I'm a strong believer in saying that systems help businesses grow rather than people. Okay, people are also important. They're very, very important. But right people and right systems is magic. So the first thing that we would see is, while I can say the metric is cash flow, the cause of that could be a
Anything.
multiple.
Okay.
Could be one, could be a mixture of other things. So we would go down, do the checkup, understand where you are right now, what needs to be fixed. Because if you see like a Burj Khalifa, you can see what it is today, but how much of the foundation below the Burj Khalifa had to be built
To support
before
that.
they could build
Wow.
the big tower, okay, and the world's largest tower. So that's what's important, is making sure that your
Foundations
foundation
are
is
strong.
strong for you to be able to scale, to grow, to sustain, to survive.
Wow, that's fantastic. And in terms of, startups, I think right now at a peak season of startups coming within the market, even in the UAE, in the US, worldwide. What's the biggest mistake you see new startups make financially? Would it be overspending on outsourcing goods? I mean, what is the biggest mistake generally you see in this market?
Starting without a plan. Okay, I would seriously say that starting without having the clarity of why you started the business, when you start the business. Today, a lot of startups are starting. Okay, people make plans when they want to go and get funding, but they haven't really thought through the whole process. Okay, an example: somebody wants to start a restaurant because he or his wife or somebody in the family cooks and cooks very well. Okay, but that's not the reason to run that business. Running a business is much more than your technical expertise.
Right.
It's a lot more that is needed. So understanding why you're starting your business and what is needed for that, okay, is very, very crucial. And having a plan is very, very crucial, because you need to have that runway. And entrepreneurship is not an easy journey.
100%.
The clarity will ensure that you also have the courage to move through the ups and downs and the roller coasters that entrepreneurship brings to you.
Because a plan to fail is without planning.
Yeah.
Wow, that's so interesting.
Yeah.
And within your experience of seeing businesses fail, because I imagine you see it on a practically a daily basis,
Yeah.
what's the most shocking story you would have? And one you've saved from failing? I mean, what's these stories you could
There are
could
many
share with us?
stories, okay, and some of them are sad, where people have built businesses with a lot of passion, but have to shut down.
Wow.
Okay, and we've seen a lot happen during COVID as well.
Right.
People went back, people had to shut down, and that was not what they wanted to do. But it came to a stage where you were choosing between stress and peace and losing all that money. Okay. What I would say is that eventually, it's not about failing. Eventually, we and our business are not going to be there together.
Right.
Okay. We have to part ways, willingly or unwillingly. And there are only 4 ways to do it. Number 1, shut it down and liquidate.
Right.
Okay. Which we've seen a lot of people do during COVID. The other one is pass it as a legacy to your children. Okay. The third one is, and you don't want to you want to pass a good legacy that your children want to then take it to the next
Yeah.
level. The third one is selling it outright to a third party and making
Exit.
a good amount of money that you want for your freedom lifestyle, and that your business could be one of the routes.
Right.
And the fourth one would be, so I mentioned, so selling your business, giving it to your children, and or having a general manager lead it with you just being on
The
top.
sidelines.
Yeah. So at the end, the whole idea is that you and your business will not be together. And choosing, there's nothing right or wrong with whichever one you choose. You want to liquidate it, but do it out of choice, not at a point where you have to do it.
Right.
You can plan it that I will do it till a certain age and then that's it, or certain time, and then I will earn so much and I will shut down my business. That's fine. You can pass it on to your employees as well. That's one more option where like the general manager could also have ESOPs, which you're giving shares to your employees. So the whole idea is knowing what you want to do with your business. But either ways, you'll need to scale it and make it a sustainable business.
Sustainable. Okay.
Yeah. In whatever format that you want to shut it down.
Wow. And from all of these founders that you've seen and these entrepreneurs that you've seen who have run businesses that have eventually failed, what's one big thing that they all share in common? I mean, that's a big way to make it sound, but there has to be always one belief which a majority of them always have.
You may feel that I'm repeating myself with
Okay.
this, is not looking at their numbers. Wow. Okay? Is not looking at their numbers. I would say don't fear your finances. Have faith in your finances. Move from fear to faith in your finances. Okay? Because numbers speak. Numbers tell you a story.
Right.
And getting those signals in the beginning, you can cross correct. You can, change your route. You can change things. And, so there are so many things that numbers could tell you.
Right.
If you're so I'll give you an example. And I'm saying this from an investor's perspective. Put a hat of an investor. If you were an investor investing in your own business, that's how you look at your numbers. Would you buy it?
Wow.
Okay? What you would do is, if my revenues are going like this, but my profits are going like this,
It's a negative sign.
yeah, you're playing a pricing war, you're just getting numbers for the sake of numbers. But that's not helping you.
At all.
It's not helping your business, it's not helping you personally. But even if you're steady, it's okay. Even if you're steady, it's okay. The whole thing, and a lot of times, it's also about pricing. You're pricing it too low. You're not pricing it right. You're just pricing it to see what will go in the market, not actually attributing what
Right.
costs have been incurred to get that pricing. A simple shift in your pricing strategy could make shifts. And what I tell business owners is, it doesn't have to be big ideas and big strategies. Simple things, simple shifts. A 1% of your revenue, if you put aside as profit in a separate bank account,
It could go a long way.
do it for 3 months, add 1 more percent to it, add 1 more percent to it. It's simple habits that help you go there. A simple shift in decreasing your costs by 1%. Take the 1% rule in every aspect.
Right.
Decrease your costs by 1%.
And make a huge difference.
Okay. Increase your price by 1%. Keep 1% aside as a separate thing. That 1% can go a long way.
Right.
Atomic Habits says a 1% difference, even in things that you make in your personal life, at the end of the year makes you 37 times more better.
Wow. 37
That's
times.
the power of 1%. So making those small shifts, and if you've not seen your number, you would not know where to make that shift.
Wow. That's 100% true. You need to actually go through and see it.
Yeah.
And to all the business owners who are now growing, you mentioned systems are the key of a business that's going to help them scale.
Yeah.
What's the first financial system a business owner has to set in place to avoid chaos?
I would definitely say making sure that you're tracking your numbers. Okay. Earlier, people would not even, just look at your bank account. Okay. And just do everything by bank balance accounting. Profit First actually helps you leverage that. But the whole idea is, where's your money going? Where is it coming from? Makes a big difference. So question is it your single customer giving you more than 50% of your revenue, and that customer goes away, it affects your business. So even tracking that metric is extremely important. You should not have a single customer giving you more than 15% of revenue. That's risky. Now, being aware of that risk and then correcting it by adding more customers is one thing, but small shifts like that make a big difference. So tracking your numbers, if I'm not even saying accounting and cash flow and profit, but just knowing how much money is coming in, how much money is going in, even keeping that simple Excel sheet and knowing the flow. Money is a currency, it's like a current, right? Knowing the flow of
where the
money is coming from, where the money is going,
Wow.
can help you put more money into the marketing where the money is coming from. Then we would go back and say that which of your products are more profitable, leverage your marketing on it. But first and foremost is tracking your money, which a lot of people don't do.
This is you would say the main reason why most businesses fail, because they just don't check their own
They
numbers.
don't check. They don't track. They don't measure.
And data it's a key behind the business's growing.
100%.
And for businesses who are, let's say, they've seen good days in the market, they're getting they're getting market share. Let's say they've crossed 1 million, 5 million, 10 million in yearly revenue, and the profits are looking good too. If you would be able to give me a few KPIs or a few financial reports that they should be focusing on, especially as they go up in the 1, 5, 10, 15, 20 million of dollars or dirhams, what would those things be? Going more in depth.
So more in depth would be your gross margins. Now, what your gross margins are, basically what your revenues are and your costs associated with the revenues. That gives you your gross margin.
Okay.
Making sure that your gross margins are not going down.
Okay.
Because that is then come your overhead expenses, but tracking your gross margin is very important. Your cash conversion cycle, how long does it take for your dollar to come back to you? Okay, that's very important. Of course, your profit figure. Okay, one big tip that I would tell people is the salary that they're taking. A lot of entrepreneurs do not take salary. Okay.
Wow.
Would not take. Now with tax, at least they're putting it on paper how much are they taking home. They're not taking salary. Now if you were to sell your business and someone else comes and you need to replace yourself, you will be putting that,
right,
you will be giving that money to someone. So making sure that yours and as per Profit First, salary is a percentage of the revenue that you're making, not necessarily what you need to take back home. But it's very important to track that, because these figures, you have to make sure that you're looking at these figures
religiously.
Absolutely religiously.
100%.
Because the whole idea is that you will be able to grow, scale, even product-wise profitability, service-wise profitability. If you go to the deep, then you know that which of your products are profitable, which is whether you want to focus on volume or value. That's also very important. So making sure you're taking salary home, making sure that there's your business is making money at the end of it, so that you could take strategic decisions to ensure that you're working with better efficiencies.
Wow. For a business that's growing, and Simran, you're a CFO, I imagine you work as CFOs in certain businesses, whether you're not in the business, but you're acting like somebody acting from above. As a CFO, when would you say it's the right time for a business to actually get a CFO on their team to scale their finances and make it more efficient?
So there's a huge difference between an accountant who'll track and a CFO. A CFO is needed when you need to scale up, when you need to look at more strategically. I would say between $750,000 to $1 million, they can start looking at a CFO. And people think small businesses don't need CFO, but that's where fractional CFO comes in. You don't need a full-time CFO, but you need that kind of guidance who will help you with budgeting, planning, helping you identify, where the leaks in your system, identify and help you with the strategic direction. If you're looking at funding, help you be prepared to be funded, and all of that. Even if you're bootstrapping, making sure that your money is being used wisely and show you that direction and walk with you, help you get the clarity, help you get the direction is when you would need it.
That's very interesting. And let's say that today you entered a F&B business who has a few franchises. You're the fractional CFO. Let's say they don't have a full-time CFO yet. Within the first 30 days of you working as a fractional CFO in a business like that, what would you initially look at or change? I imagine you do your checkup at first.
That is the basic start, and it could take 30 days. Between the first 30 to 60 days, what we would do, and we would understand. We would also, what is very important for us at the beginning when we're taking a CFO assignment is not only understand the business aspirations, is also understand the personal aspirations of the owner. So understanding where they want to be, where their business wants to be, where whether the personal aspirations and the business aspirations are being aligned. If not, we help them to align
Yeah.
that. So deciding where you want to go, it's important to know where you are today as well.
Okay.
So if you were taking your car out on the GPS, your GPS will define where you're going today when you step
Location-wise.
out. But if it's your business, you need to know exactly where you are. So the first and the foremost thing is we start with a health checkup. Okay, from that health checkup would come a list of observations and our recommendations, and we work with their team. We work with, so it could be depending on the size of business, they will have a single accountant, or they would have an external accounting firm working for them, or they could have a team of accountants. So we
Right.
understand what is it that we could do via their team. We'll start putting systems and processes in place. It's an ongoing activity, while we will start working on their cash flow forecasting as well. Even if we have limited data, we kind of start with it for the 6-week cash flow forecast to
6-week cash
understand
flow
where they are.
forecast, okay.
Eventually, it would be a 13-week forecast, but we start minimum with a
6
6-week
weeks.
forecast. And stemming from the health checkup, we would decide our direction on what is priority. So we also understand from the client. Now, if the client has an investor ready, okay, and he wants to do it, so then we need to work on it. So then that kind of urgency with what is his deliverable, we work backwards. But otherwise, the whole direction gets mapped out with the business owner. Stemming from our report would be what needs to be done,
Right.
who needs to do it, whether it's their team, our team, jointly, by when it would be done, and a whole project plan is prepared accordingly. And we look at the next 12 months, bring it down to the next quarter, and then bring it down to monthly.
That's fantastic.
Yeah.
And imagine a lot of businesses would benefit from a service like this, especially when
100%.
they're
100%.
being led by the blind, which is themselves most of the time.
100%.
In terms of founders, every business has a founder, right? You mentioned that they should be taking a percentage of the revenue.
Yes.
How much percent? I mean, how should they define how much they should take home? Should they take home a fixed, or how exactly would you say?
So again, I would recommend profit first. Profit first determines how much you can take based on your revenue. So if you are a million dirham and less business, 50% of the revenue should be your salary, 5% should be profits. Now, most of the people would not take that much, right? But the idea is because the business cannot run if you're not there. But most important metric here would be your expenses should not be above 30%.
Above 30%.
Okay, that's the important metric. As you grow, so this one is valid for a zero business, a startup from zero revenue to $50 million. For a $50 million, the person would not be taking any salary,
Right.
would be taking a percentage of profit because he or she has a whole team,
Right.
has a system working for them. Because the way I would define is, as a business owner, you get remunerated in 2 ways.
Okay.
Salary for working in the business, profit for working on the business. So as your business grows and you start building team, you start building systems, you're working more on the business
Than in the business.
So as a founder, between $0 to $250,000 or less than $1 million dirhams, you are working in the business
Right.
full time. As you keep growing, your salary portion increases, your profit percentage increases, and at the end, you're taking more of the profit
Right.
than the revenue. And remember, it's a percentage of what you're making. If you're making more, you're taking more. If you're making less, you're taking less. But that's important. That's financial. Non-financial, I would definitely tell people that if you don't know that figure, calculate your personal expenses. Okay? That personal expenses should be the minimum salary that your business pays you. Otherwise,
Right.
there's no point.
100%.
You're better off working for
job.
someone else and ensuring that your personal expenses are taken care of. If that is 25,000 dirhams a month, take 25,000 at least. You could take more. That's not a problem. If it's 50,000, then take that much. Or you should prepare your business to be able to give you that.
Right.
You might have started your business with your savings, but you cannot be pulling money out of your savings to run
24/7, yeah.
your household month on month. It has to come from your business.
That's amazing. And that's so important.
Everything we do in our business is personal. That's the minimum that your business should easily be giving you month on month.
And as a business, money comes in and money comes out very fast. How much cash how much cash liquid should a company keep on hand on average, depending on how much they're making?
So it depends, but minimum you should have 3 months of expenses
As business.
as in your business that you should have kept aside, that you should be able to run it. Do businesses have that? They don't even know when the next month stuff is coming, but that's minimum. Then up to 12 months, and then after that I would say please invest that money.
Yeah.
Don't just keep it. If you have that kind of
Extra
money,
cash.
extra cash, please invest
Fixed
it.
deposit,
Yeah.
anything could work,
Yeah. Yeah.
And I heard BO is giving like 6% on a fixed
They've
deposit.
reduced
They've
it.
reduced it
Yeah,
now,
yeah,
but I
yeah.
mean 6% is amazing.
Yeah.
And as a founder, you have different priorities. You will have reinvesting into your business for growth, distributing profit to your shareholders, or saving for a downturn. What would you say out of those three, in order, would be most least? None of them are least important, but most to least important in terms of priorities.
So I wouldn't say anything is least important, but the first and foremost that you need to keep aside is emergency funds.
Okay.
I would say even if business owners have debt,
Right.
okay, I would say keeping that emergency fund is important.
Okay.
Profit First also helps you crush the debt, and we have a whole plan to help you through that. But I would definitely say first and foremost is to have an emergency fund. It could start with $1,000. Then it could go to 1 month's expenses.
Yeah.
But having that before you do anything else, I would say is very, very important.
Okay. And for businesses who are, let's say, at 50 million, they've saved for the downturn, would you tell them to increase shareholder value in terms of giving them more dividends, or still put money back in the business?
So it again would depend on their why and their purpose of what they want to do, and it would be on a case to case basis. You want to scale, you'll put money back into your business, and a lot of people who are at that level don't have just one business.
Okay. Yeah.
Generally, when you're working on your business at that stage and you're doing well and you have profits, then most of them don't put all their eggs in one basket.
They have multiple assets.
Yeah.
Wow. And as a business does grow, they're going to scale. But when's a point they should stop scaling and just purely focus on their finances? At what stage,
So there's no stage at which you stop scaling. And again, like the why, whether you want a freedom lifestyle business or you want a performance business or you want to build a unicorn or you want to build an enterprise, it depends on your why. You can never stop scaling, because if you are at the same position you will only go down.
Right.
So I would not say anybody has to stop growing or stop scaling, because things that are there today were not there yesterday.
Right.
AI is going to disrupt everything. So you need to be
100%.
constantly learning. You need to understand the market. The markets are shifting. So I would not advise anybody to stop scaling.
Okay.
It's to what energy, what focus you want to put on growth. And then if you can't do it, you hire someone else who can.
Right.
And then look at either, if that's the case, then you exit and use one of the exit strategies and sell your business or sell part of your business. But you cannot stay at the same level ever.
You can't. You can never.
You cannot.
Regarding entrepreneurs again, everybody has their own financial beliefs. So, for example, I only invest in gold, or equities are a scam. In terms of finance, of a financial situation of a company, what's the biggest mistake or biggest misbelief you see entrepreneurs have?
They put all the money back into the business. The reason people are not taking salaries is you're putting everything back into your business. And I want people to take the salary and then invest back in the business. I'm not saying don't invest back into the business, but it's very important is that you look at other investments as well, and grow your business. But you should be taking money home.
100%.
Yeah.
And I think we can wrap it there. I know it's been a little bit less than an hour, but I've pretty much gone through all my points. I got everything I wanted out of the podcast. Thank you so much, Simran. I really do appreciate it.
Thank you for having
it was
me
an
here.
amazing
And
podcast, some amazing insights. Thank you.